Hello, this is Greg Owen, the CEO of the GoCo Group. Thank you for joining me today, wherever you are in the world. I know we have audiences around Australia and also parts of Asia and New Zealand. So thank you once again for joining me. I have a very special guest today, somebody I've never actually interviewed before, but somebody I have known about for a long time, because he's been a famous author in Australia. I don't know if it was 10 or 15 years ago. He had a book, Zero to 130 Properties. It stayed in the bookshops forever. And every time I went to the airport, there it was, Steve's picture, whatever. So Steve McKnight is who I have with me today. He's a property expert. He has not only he's the real deal. He walks the talk. He buys properties. He has been a champion educator to people right across Australia for a long time. And it's my pleasure that I've been able to seduce him to come on and speak, have an interview with me and talk to everybody out there in the GoCo group. With no further ado, welcome, Steve.
Hi, Greg, and hi, everyone. Don't go telling my wife that you've been seducing me. That might lead to raised eyebrows, but it's a great pleasure to be with you today here.
Steve, one thing I must ask, and that is that I know that when I was watching you and, you put on a lot of live events, you were all over the bookshops, then all of a sudden you disappeared
Well,
and
I
we
never
didn't
got,
see you for a while.
yeah, I never got into this for a job or to build my ego or to make it all about me, become a celebrity, anything like that. I wrote that first book, Naught to 130, just to try and help people understand how some washed up accountant got out of doing accounting and used the power of positive cash flow property to forge a life where I didn't have to sell my time for money anymore. And then I was happy to run events and to teach people about the way that I approach real estate investing, but I'd never wanted to make a career out of it. And when I got to the point where I burnt out because I didn't want to do it anymore, I didn't need to do it for the money, so I concentrated on other things.
Fair enough. Fair enough. Steve, I know that what I'm going to talk about today, I know you have a burning passion once again for property and property education. And one of the things I saw on your website that impressed me, what you said, I know everybody would love to hear. You know, I'm not telling you anything, but Australians have had a love affair with property for a long time. And, Harry Dent and Robert Kiyosaki have talked about how property market has bubbled in Australia and it's going up and up and up. And it just doesn't seem to ever end. And as they both have said, every bubble must burst. Now, of course, at the moment, it was once that Shanghai and Vancouver and Australia were neck and neck as the champion property nations, going up and up. And I think Australia's almost edging ahead. I mean, you may know more about that than me because it's not stopping. But I like what you said. You said if you want to know if the property market will keep bubbling along or if prices are about to crash. Now, everybody would like to know that. And so I'm going to kick off with, this is what we're going to be talking about. And this is your headline, not my headline. So I'm sure you would have a lot to talk about that headline. What were you thinking when you had that headline?
Yeah, well, I think the overarching investing principle is that it's always a great time to buy a great property. Where, but when people don't know how to read the market, they don't know what the time is. And if they don't know how to do due diligence, they don't know what a good property is. So then people fall back on speculating about whether prices can continue to go up. And the short answer is that in Australia, there is a floor under real estate prices caused by immigration. We simply don't have enough places for everyone to live in the house that they want, particularly to own it. And so therefore there's pressure for rents to keep going up because vacancies are very low. And then what I suspect is going to happen is if and when interest rates start going down again, then people will move out of the rental market into the ownership market, and that will cause property prices to kick on again. And it's already happening in markets like Adelaide and in Perth and Brisbane, which are the strongest markets at the moment in Australia. It's just that the larger markets, Sydney, although it's still going up, not going up by as much, and Melbourne, where things are a bit dire because the government found a way to put a wet blanket on the real estate with its taxation policy. But the short answer is, for anyone listening to this, what they're really asking themselves, am I going to lose money by investing in real estate? Am I going to buy something that is worth half of what I pay for it in a year's time or 2 years' time or 3 years' time? Now, some market commentators like to attract attention to themselves by continuing to prophesy about a market crash. And eventually they'll be right, because a broken watch tells the right time twice a day, as we know. But in the meantime, while people keep forecasting prices are going to crash, and they don't, people price themselves out of the market. So to summarize what I've just said, it's always a great time to buy a great property. If you can invest in the skills as an investor to be able to read the market and be able to read the property in the market, then it doesn't really matter what happens to property prices, going up or going down. You can still make money in the market. And that's what I'm big on, is people equipping themselves through education and training on how to make better investing decisions.
Okay, well, saying what you just said, now that's very interesting what you just said. In fact, there's a lot to unpack there. And the first thing I want to unpack is that, Phil Anderson, I'm sure you know who Phil Anderson is, the property guy who has been a bit of a guru in giving his professional intelligence. He lives now in Bali, and he runs a big fund. He's a famous guy. Was once upon a time one of the commentators for Port Phillip Publishing. But Phil Anderson, and like a professor, Phil said there's an 18.5 cycle. And he's been drumming on about this for a long, long time. And he's saying that it doesn't matter what happens, come 2026, 2027, we are in for a property adjustment. Now, saying all that, that's all very nice, but I know here in Australia, the problem is supply and demand. It doesn't matter which way you look at it, we don't have enough houses. And when you mentioned Brisbane, well, it's going like a skyrocket at the moment, because I know I've been shopping around there for the last month, and every day it's a new price, and it's a new price up. And it's the supply and demand. And what happens if we're here in 2 years' time or 3 years' time, and the supply and demand is still there? You've got the builders. I know Tim Gurner, the builder, very, very well. And Tim said, my problem is it costs so much more to go and build a property, so I can't sell it for less. It's impossible.
Well, let's just pause for a second, and let's say that Mr. Anderson is right. And,
yes, let's imagine he's right.
And property prices crash.
Yes.
Okay. So what we need to do in our investing strategy is to stress test the way that we invest. And so what would happen if property prices halved? What would that mean for us? And I've lived through something like this in recent memory, because I was investing in the United States pre the global financial crisis, and then I went in a big way after the global financial crisis, when property prices were half or less, 75, 80, some cases 90% less than what they were worth at the peak. And what we've learned from that experience is that, yes, property prices might short-term correct and maybe even crash, but then over the ensuing decade that came thereafter, they recovered. And here's the point, right? Here's where I'm getting to. If you're a forced seller in a down market, you could lose your shirt, your pants, and your underwear in the one go. But if you're not a forced seller in a down market, then yeah, on paper, the value of your assets might go down. But so long as you don't sell, those assets will also later on recover. So it's really the question you want to be asking yourself is, oh my God, not what will happen if property prices correct, but how will I fare if they do, and what can I do to manage and mitigate the risk in my investing portfolio today, knowing that if property prices were to correct in a couple of years' time, that I would also want to be taking advantage of that as a buyer, and definitely not wanting to be a forced seller. So what I never do is invest guessing what's going to happen into the future, because you're always going to be wrong. No one has perfect timing all the time. But if you
Mm.
can form a strategy and then look at, well, how does that strategy sit if prices go up? How does that strategy sit if prices go sideways? How does that strategy sit if prices go down? Then all of a sudden you're doing what I do to tame risk, and it's called, you need to name what the risk is. You need to number it, i.e., come up with a dollar value so you can understand what risk is in dollar terms. And then the last thing you need to do is numb it, which means come up with strategies to manage and mitigate that risk insofar as possible. And it's no different to getting in a car and saying, well, today I need to get from A to B. What happens if you have an accident? Well, I'm not planning to have an accident, and I can't really control what other idiots do on the road, but that's why I wear a seatbelt and stick to the speed limit and obey the traffic signals. We just need to do the same thing in our portfolios. Stop trying
Yes.
to pick the perfect time and start trying to pick the right time. And the right time, we answer the question by saying, who wishes they had have bought more property 10 years ago? Everyone
Oh,
puts their hand up.
no,
And then
of
we say,
course.
well, where are you going to be in 10 years' time? Like, don't keep making the same mistake. Learn from what you didn't do previously and adjust so you can act today.
Well, the fact that developers can't build the damn things only at a certain price, I don't see how it can come down. I mean, I want to believe there's always a bubble that will burst because it's common sense. But saying that, let's look at more common sense. If people still keep coming into Australia and builders can't build at a certain, they can only go to a certain level, they can't go under it. So that means it's got to be sold above that. I mean, it tells me there can't be a crash.
Well,
I'm
not, not,
happy for there to
not,
be a crash.
not necessarily, because it happened in America. So the cost of construction was let's say, $60 a square foot. And
Yeah.
then what happened was all this property got dumped on the market, typically commercial real estate, which was the fund that I was looking to buy in at the time. And you could buy at $20 to $30 a square foot. So roughly 50% of replacement cost. And all that meant was that people stopped building because you couldn't make money out of building because,
Which is what's happening at the moment.
and then that puts a floor again under the pre-existing stock, which over time will drag it higher. Let's look at the investing theory. If you're a tenant and you've got a choice of two buildings, building one, building two, and they're both at $100 a square foot to rent, say, or pick a number, which one do you go for? You go for the nicer building, the newer building. Yeah. So then you have to
Yes.
ask yourself as an investor, how much less do I have to discount the rent by to attract a tenant for my older building? And so you'll never get the same as a brand new building. But as the cost of construction goes up, the return that an investor has to make in order to stay the same means the rents have to go up. And as the new product rents go up, they drag the old rents up with them. And so you may not be able to get the highest rent in the market, but if you can buy sensibly, the phenomenon that you're talking about, construction costs going up principally because of inflation and supply shortages, drags all rents higher. Now, there can be
Mm.
shock events that break the rule, as we saw happened in the United States of America in 2009, 2012, but they're only short term events. Sooner or later, the market normalizes. So, again, if you're not a forced seller in a down market, or if you can take advantage and buy during times when the market corrects, then you'll do well.
Are you telling people right now to continue to buy investment properties and go on as life is normal? Are you telling people that right now?
You can't see this, but on my screen, my second screen that is just on the side there, I have a heads of agreement that I've written up to purchase a $28.5 million property today. I've bought $50 million worth of positive cash flow real estate in the last 6 months. So I'm not afraid of a market correction, so long as, and this is the point, the positive cash flow means that I'll never be a forced seller in a down market.
Yeah, that's right. And your answer is the same as Phil Anderson's. That's amazing. It's because I interviewed Phil a couple of years ago along this line, and he said, "Don't sell anything. Make sure you've bought properly where the rent's going to be always there, and just carry on. And you will eventually win big time. So don't sell."
Look, there's only three things that cause profit, right? This is the future value of money formula. Your ability to have capital invested at a rate of return and time. Capital, return, and time. They're the only three factors. The longer the time, the better. The better the rate of return, the better. But unfortunately, risk and return are related. So you need skill to dial down risk to get the higher returns. And you need a way to get capital. Now, that capital, some of it might be borrowed, but you also need a way to save money yourself or get access to capital yourself, which then comes down to a make and manage principle. How much money can you make, and how much of that money can you keep so that you can then deploy it as capital for investment purposes? And that was my book, Money Magnet, which was the latest book that I put out about a year ago, trying to get people to realize you got to make it, you got to manage it, you got to multiply it, but amongst all of that, you've got to try and find a way to give your money meaning, because otherwise it's just an ego exercise about trying to build more wealth on paper. How much is enough? And then you can either use your money for survival, i.e., to pay for your lifestyle and the things you want in life, or significance, which is using your money to touch, move, and inspire other people, and to give purpose to your money, which will create a legacy which to some extent will endure when you're no longer around anymore. And so what I find is people that invest in survival never ever have enough. They're always worried that someone else has got something better or newer or bigger. Whereas people who are able to invest in significance find purpose in their money and a reason to keep going. And then as they bless others, the return that they get from that blessing isn't necessarily monetary in nature, but it makes them feel like they're living a life well lived. They don't need money to feel like they're winning, because the social dividend that they're attractive via their philanthropy is feeding their soul.
While we're picking your brain, I'm going to ask you questions that most people want to know. So they can be shortish answers,
Rightio.
but if somebody's out there buying right now, because you remember there's all different ways to buy. You can buy a property that's new, it's just been completed. You can take a property off the plan. You can buy an old property. You can buy a very old property. You can buy land on its own. You can buy commercial real estate. There's many things you can buy. So let's start from the top. A new property, just completed, not off the plan. No problems as far as you're concerned.
Greg, I'm going to give you a different answer. And
Good. I want a
with
different answer. I like that.
with me, you'll always get a different way of looking at things. I'm going to ask a question. I'll ask a question of you, but I'm really asking a question to anyone who's watching this webinar or listening along to it, this podcast. So, Greg, would you rather be a good plant in bad soil or a bad plant in good soil? Would you rather be a good plant in bad soil or a bad plant in good soil?
It's an easy answer. If you don't have the right soil, you're done.
Well, that's right. So let me ask you a different question. Same principle. Would you rather have a good property in the hands of a bad manager or a bad property in the hands of a good manager?
Always want a property in the hands of a good manager. But
Right. So, and
okay,
exactly right. All right. So let's keep this
yes.
discussion. So you're asking me, should we focus on a new property or not? So there's two things that we can talk about here. We can talk about plants and we can talk about soil. If we want to talk about plants, that is the nature of the product, the investing product, old house, new house, particular location, made of weatherboards, made of bricks, what kind of tenant, etc. These are all what I call structural questions. And there is a time and a place for a structural question. But really, the reason why you ask a structural question is for due diligence purposes, i.e., to try and ascertain or undertake an assessment of whether or not there's risk there that you don't know about. Aside from the structural side of things, the soil comes down to you. You are the soil of your investing. You are the thing that your investing is going to grow in. So your ability to be good soil, to, as Bob Allen once said, find it, fund it, and farm the deal, right, is the real thing that people should be investing in. Because otherwise, you are always at the mercy of whatever your asset gives you from its structural nature. And therefore, if you're not really in control of your investing, and so you take on the character of being a speculator. So what does that look like exactly? How do I fertilize the soil? How do I get better soil? Well, listen to things like this, read books, attend seminars, network, go and talk to other investors and find out what they're doing and what's working, and just as importantly, what's not working, and be aware of what's going on in the market and build your investing acumen so that you can make better decisions. And then based on that ability to make better decisions, you'll look at what's available in the market. If there's 300,000 properties for sale in Australia right now, or wherever it is people are who are watching or listening to this, then if you ask the real estate agent how many of those 300,000 properties would make money, the real estate agent's going to say all of them. So if all we're trying to do is make money, it doesn't really matter what you buy. But you don't just want to make money. The role of a good investor is to make the most money in the quickest time for the least risk and the lowest aggravation. There's 4 parts to it. And so sometimes it's okay to make less money if there's less risk or lower aggravation, or you can make it sooner. And for instance, I bought a property in Brisbane on a 6.25% return. You might say, well, 6.25% is not exactly getting me very excited, Steve. My pulse isn't racing, and nor should it. But when you look at some of the other things that are happening with this deal, like the length of the lease and the quality of the tenant and the rental bumps that are factored into the lease, then for the risk, a 6.25% return was actually worth it. So what we want to do as investors is not get caught up on a certain return. We want to ask, does the upside outweigh the downside by enough of a margin to pull the trigger and purchase it? So coming back to an old house or a new house, I would say, why are you buying the asset? What outcome do you want? And does buying this asset allow you to achieve that outcome? If the answer is yes, well, why not? If the answer is no, look elsewhere.
I love your science. I love your intelligence. You're a thinker. I love it.
Well, it's
Now,
so
recently,
easy. Well, Greg, it's so easy just to go and buy something and hope that it makes money. But how much of our future is left to choice and how much of our future is left to chance? If you want a more certain financial future, make more certain financial decisions, make more choices and leave less things to chance. Makes sense.
I had a gentleman. In fact, he only passed away in the last 2 weeks. His name's Graham McKnight, and Graham is a very wealthy developer, property owner in Sydney. He died at age 94 or
Wow.
95 just the other day. And I remember asking Graham this question because he always is known to have hundreds of properties getting great returns. And I said to Graham, what's the secret to your science? Why are you so wealthy? Why? And he said, oh, Greg, it's simple. I didn't sell.
That, and I did things others didn't, is what I've found is a common denominator. When people had a choice between sitting on the couch or going and doing something that required effort, I went and did the thing that took effort. And I did it and I did it and I did it. And it wasn't once that was the difference, but it was what Tom Ziegler would call being persistently consistent, doing that others won't to get what others don't, which is the difference over time. The gap is only a little bit per decision, but over time, the consequences of that gap uh, grow or become wider and wider. So if you go back and you look at your life and say, well, if I had have made that decision 20 years ago to do this, where would I be now? Well, because of the passage of time, you might be in a much different position. Had you have not got divorced, had you have bought the
Yeah.
property, had you have not sold the investment, etc.
Now, look, you also said on your website recently you had a surprising findings of your latest property market research, including why now is the calm before the property storm,
Yeah.
and what you need to be ready for and prepare for. What's going to happen here? What storm?
Well, the storm is going to be the transition of wealth away from people who know what they're doing, or people who don't know what they're doing, to people who do know what they're doing. And what
We
I'm
weren't
talking about
expecting that
here,
answer. I wasn't expecting that answer.
well, so many people don't know what they're doing, and they're just riding the roller coaster. And if it's going up, it's going up, and if it's going down, everyone's in a panic. But as the market transitions away from being a rental market to a buyer's market, there will be a stunning amount of money that is going to be made by people who took action before it happened. And so, what I'm all about is saying to people, how are you preparing for tomorrow's profit by taking action today? And you can't profit from tomorrow's market if you're not preparing and taking action today. You can't shoot the winning goal in basketball sitting on the sub bench. And so, right now, while people are thinking, oh, I don't know what to do, they convince themselves it's okay to do nothing, or January turns into February, which turns into May, which turns into October, which turns into 2025, which turns into 2026. There's a saying that people should all over themselves. I should do this and I should do that, and they should all over themselves. Well, what I want to do is get people out of the should category and into the could category and into what I call the do, doing, done categories. So, what do you need to be doing in order to get something done today
Mm.
to make a positive step towards your financial future? And sometimes, particularly for smart people, oh, I just need to know more. Well, I've got a daughter and we call her Moo Moo because she loves cows. And we say to her, less mooing, more doing. Less procrastination, less talking about what we should be doing, less navel gazing, less going to another seminar and another seminar and another seminar, but not doing anything with the information. Start implementing. That's where the money is won and made, not just sort of reading for curiosity's sake.
Steve, because time is running away, I want a couple more questions answered. And of course, you mentioned about real life case studies showcasing recent property acquisitions,
Yep.
dissecting the what and where and why, and the strategic mastery behind each purchase. I think you've alluded to some of it, but do
Yeah.
you have
So
another?
yeah, I mean, I can predicate the answer here because Greg, I mean, people may not realize, but before I got into accounting, I had a multi-decade career as an accountant, and the sort of accounting that I was doing was in risk assessment and management via internal and external audit. So I have a particular way that I approach real estate investing that is proprietary to me and is based on my chartered accounting background and my history buying hundreds of bits of real estate, and also on my audit training. And that's about assessing and quantifying risk, which is a bit more than what we can go into today. But through the fund that I set up recently to acquire Australian commercial real estate, through that fund, we've gone and bought just under $50 million in the last 6 months of commercial real estate, where we believe the risk to the return dynamic is mispriced in the market. So I use my intellectual property to identify the opportunities where the return for the risk is mismatched to the investor's favour. And so that proprietary knowledge is what I talk about at seminars sometimes, although I don't do many seminars anymore because time is precious and I'm now over 50 and don't want to be a seminar presenter for the rest of my life. I usually do one or two max a year. And then through that fund that I run, people who want to co-invest with me can take advantage of my ability to be able to fund and farm those deals.
Yes, look, I'm going to ask you that question at the end, but I know with a recent conversation I had with my son, he's in his mid-20s. He's been living in Japan for 4 years, and he's come back to Australia to see, real estate. The cheese has moved, and he wanted to buy his first home and all that sort of thing. And of course, he sits in the corner, crying in his rice bubbles. I mean, he's concerned about how everything's gone up, and he could never get involved. His salary can't meet what they need to get a loan, yada, yada, yada. And I said to James, look, Australia is a lucky country. We have got tremendous regulations. Everybody wants to live here. And the interest in Australian property is going to always be there. In fact, in 20 years' time, you wish you bought more and more and more. And I said, it's going to be there. I said, you're just going to have to get the right salary, make the right sacrifices, and go and buy some property. And don't sit around feeling sorry for yourself, because that's the life we're in. But it's a great country to buy property because we are so beautifully regulated here, and everybody wants to live here. There couldn't be a better place to buy property. Do you agree with that?
There's always perhaps somewhere better where you can buy, but you can only buy where you can buy. So if you are someone who is an Australian citizen or you've got permanent residency, you can borrow money and take advantage of buying in the market. I say this over and over again. Don't worry about what you can't do. You can sit here all day long and say, oh, I can't do this and I can't do that. And I can't do, oh, life was easier 20 years ago for you, Dad. You could do all these things. I can't do them. Don't worry about
Yeah, that's it.
don't worry about what you
Yeah,
can't do. Just worry about what you can do.
yeah,
So
exactly.
what actually can you do? Oh, I can't buy in Sydney. Could you buy somewhere else? Like, don't worry about where you can't buy. Worry about where you can buy. Don't worry about what you can't do. Worry about what you can do. Don't worry about uh, things were better, different, harder, easier, whatever. Yesteryear, that's gone. That's a memory. You can only worry
Mm.
about what you can do today to prepare for tomorrow. So I would empathize with your son and say, do you know what? When I started buying real estate in the late 1990s, people were saying to me, property prices are going to crash. And here we are, 26 or so years later. And guess what people are still saying, Greg? Property prices are going
Same
to
thing.
crash.
It's
Now,
going
if
to
I had
crash.
listened to that person 26 years ago and sat on the market waiting for property prices to crash, where would I be now? I would be spewing that I didn't do more all those years ago.
Yeah,
So
absolutely.
everyone can do something. If it's make a bit more money, manage their money a bit better, multiply it smarter, just look for the small things you can do rather than the big things that are going to fix everything. And little bits of
Mm.
progress over long periods of time will transform your life.
I recently, Robert Kiyosaki was in Australia, and I was part of hosting him here in Australia. And it was a very, very popular tour and very successful, a sellout everywhere. And we went on a boat trip, just a small group, and there I was having a steak. Robert Kiyosaki sitting beside me, and I said, "Here's my moment. I can ask this bloke whatever here." And of course, we get on very well. I've interviewed him many, many times, so we have a bit of a chemistry. I said, Robert, I said, you've made it, you lost it, you made it, you lost it. Now you're making it in truckloads. I said, mate, you're amazing. What? Come on, give me a secret. Why are you a man that goes and makes so much money? You're like a money machine. And he said to me, oh, it's easy, Greg. Just get a hold of as much money from the banks as you can. Just get their money and bloody use it. And he said, I came back from the dead and it was all their money. He said, I don't want to pay them back. He said, I'm just going to buy and let the whole machine work. As long as I buy smart, I'll do well. And you should do
I,
the same.
I suspect that if we had have gone back to Robert now versus Robert 20 years ago, a similar
Mm-hmm.
thing would happen as if you went to Steve 20 years ago and Steve now. You
Oh,
you learn
interesting.
you learn a lot more as you get older, and instead of trying to evangelize people that this is the right way to do it and you need to be doing this, like years ago, 20 years ago, you need to be buying positive cash flow property, you need to get in it. These days I don't do that anymore. I just say,
Mm,
you know what, there's many ways to skin a property cat, and you've got to find the right way for you. And
mm.
if you want to invest in a way that I don't, well then that's fine, because there's lots of ways to making money. But if you want to get an outcome where you don't have to work for money anymore and you want to retire earlier on in life and you want to use real estate to do it, then find someone who has done what you want to do and find opportunities to spend as much time with them as possible. So if Robert Kiyosaki is your man, go talk to Robert. If there's a person out there, a female who's your role model, go and sidle up next to them and spend as much time as you can. Because what I've realized is that the more time you spend with someone, the more likely you are to train your way of thinking to the way that they talk through their language patterns and their behavioral patterns. So I would say, because I mean, I read Robert's book back in the day, and I went to Robert's 2-day seminar in 1999, which is a long time ago. And I got to the point where I felt I could learn as much as I possibly could out of Robert, and then started to look to other mentors. But I'm pretty sure if I went back and studied with Robert today, he'd be talking about things differently than what he did 20 years ago.
Oh, I think so. And he's been burnt. He's come back. He's done everything. I like talking to people that are scarred generals. So it's interesting to get their take on it. Now, my last question is, of course, I see here that you've launched into a managed fund. It's interesting, last year. And tell us about it. I mean, you're a smart man. I know you wouldn't do something unless you had done your homework and you were committed to it. What is this managed fund?
Well, the first fund I ran began in 2012, and we went and raised about $150 million and bought commercial property in the United States. And that fund ran for a little over 11 years and did really, really well. It would be one of Australia's...
Was it a property trust?
Yep, it was a real estate investment trust. And while past performance is not a guarantee of future performance, and the fund is now closed and winding up, we did over 16% per annum for a decade in that fund, benefiting from positive cash flow, capital appreciation, and the Australian dollar. So as we wrapped up that fund, people naturally said, Steve, this has been a roaring success for us. What have you got for us next? And I said, you asked me earlier where I went for a period of time. When you're managing someone else's money and you take it seriously, it is effectively a full-time job. And so now I'm over 50 years old. I said, I don't really want to do this anymore. But what I will do is we can start up another fund which will concentrate on Australian commercial real estate, different dynamic, different risk profile. And what I will do in that fund is I won't do the compliance and the reporting like I did for the US fund. I won't manage and head up operations like I did for the US fund, but I will take on the finding, doing the due diligence, and preparing to hand over to management acquisition of the properties. So that's my role in this new fund, to find the good deals and to make sure they're not duds as much as possible, and to then hand them over to the operations team to manage them and to do the compliance and the reporting. So it's a retail fund. It's called the Strategic Opportunities Growth and Income Fund. And if people are interested in finding out more, there's an offer document you have to read, of course, because it's a regulated investment. It's not just some fly-by-night syndicate. If I can give the website, Greg, that people can go to.
Absolutely. I was going to ask you.
It's really simple. It's just SOGIF.au. SOGIF.au, which stands for Strategic Opportunities Growth and Income Fund. SOGIF.au.
Terrific. Well, Steve, thank you for giving up your time. I appreciate it. You've given your time up for free, which is very nice. I love your angle and your attitude to property. It's refreshing. It's good. And you're not saying that one way fits all. There's all sorts of ways to get to a wealth through property. And you're open to always learn and whatever. And thank you for joining us.
Thanks for the opportunity, Greg, and wish everyone all the best with their investing.
Thank you, Steve. Well, everybody, that's the end of the program. Like I said, we get some pretty sharp operators. There's no more sharper than this man, Steve McKnight. And I hope you've all enjoyed it. This is Greg Owen signing off, and we'll see you again real soon. Bye for now.